This video is about understanding the difference between traditional merchant accounts and payment aggregators like Square or PayPal. I'm Gingergaye with electronic money company Merchant Services. Merchant accounts and payment aggregators like Square or PayPal are two different ways that businesses can accept payments, and they have distinct characteristics and advantages. So in summary, the main difference between traditional merchant accounts and payment aggregators is the level of customization, the pricing structure, onboarding requirements. Traditional merchant accounts offer more competitive rates based on your particular kind of transactions, but with a little more complexity and more requirements up front. Payment aggregators simplify and standardize the process. They are more suitable for small businesses or those looking for a quick setup and easy payment processing solutions. The choice between the two depends on your business, on the business size, needs, and the degree of control and customization you require. Let's break down the key differences between these two payment processing methods. Now we'll talk about payment aggregators like Square and PayPal. First of all, you don't have an individual account, it's a shared account. Payment aggregators offer a shared processing infrastructure, and many businesses use the same account, which is often referred to as an aggregator account. In the case of Square or PayPal, numerous sellers share one single merchant account. With a traditional merchant account, each business gets its own unique account. This means that your business has its own MID number or merchant identification number and is treated as a separate entity in the eyes of the payment processor. Onboarding is simpler with an aggregator. They typically have faster and more straightforward onboarding processes. They may require less documentation, fewer underwriting requirements. Makes it faster and easier for small businesses and individuals to start accepting payments. Underwriting and approval. To open a traditional merchant account, businesses typically undergo an underwriting process. This involves credit checks, background checks, and approval processes that can take a couple of days or longer if more documentation is requested based on the industry or the manner of accepting payments. And I might add that it's a soft credit check, not a full hard pull on that credit check. Let's talk about customization. Aggregators offer less customization and control, but everyone pays the same standardized fees. Let's talk more about standardization with the rate pricing. So aggregators usually have a simplified, predictable pricing structure. It's a flat percentage rate. Maybe it adds a flat transaction fee, and there's no other monthly fees or complexity. However, the flat rates are a bit higher and non-negotiable because they have to cover all the risks without knowing which merchants are processing in a low or high risk category. You are generally paying a bit more for standardization, the simplification, and the ease of signing up. Traditional merchant accounts offer a higher degree of customization and control over payment processing. You can negotiate the rates. You can set up specific payment tools for accepting payments. Often you have more flexibility with your payment gateway and your processing hardware. Pricing structure is different. Traditional merchant accounts usually have more complex pricing structures, including interchange fees, processing fees, monthly services fees, compared to aggregators which have a flat price. The costs can vary with a traditional merchant account based on factors like processing volume, the type of card used for payment, how it is processed in person, over the phone, online, or versus a gateway, but the fees are also negotiable. 6, handling chargebacks. Payment aggregators do not fight for merchants to win their chargebacks. The money is simply lost. With a traditional merchant account, merchants are typically responsible for managing and handling chargebacks, which can be time-consuming and require a good understanding of the process. But processors have a support line to guide the merchant on proper practices to prevent chargebacks and how they can assist the merchant in winning them back. Reporting. There's no reporting of your particular business transactions with an aggregator like there is with a private merchant account. Fees are deducted from each transaction before it is deposited into your bank account. They keep it simple for small businesses, but reconciliation and bookkeeping can be challenging as these businesses grow. With a traditional merchant account, statements are provided monthly with a traditional merchant account so that the merchant can balance the credit card deposits to their bank accounts. 7, let's talk about customer support. Merchant processors have customer support lines 24/7, 365. Service and support with an aggregator. Basically, they do not have customer support lines to answer your questions about missing transactions or troubleshooting equipment. Information can be found on their website. Hope this helps you understand a little bit of difference between Square and PayPal and going to get your own merchant account. If you want to ask any questions, feel free to call us at 505-296-2847. We'll be glad to help. Thank you. Bye.